Welcome to the seventh episode of Dividend Investing Insights, your go to source for all things dividend investing. Join us as we explore techniques to maximize your investment returns. Subscribe now and take control of your financial future with the power of dividends. In the episodes today, we will look at when to sell a stock. Until now, in all previous episodes, we have looked at some of the parameters that could drive you to buy a particular stock. Today, we will look at another very important aspect of when to sell a stock. What could be some of the reasons for you as an investor to sell a stock? Now, before we go into a list of items that you could use to make a decision, let us look at the performance of the markets for the week. The markets went down with S&P 500 losing 3.64%, Nasdaq lost 5.44%, and here locally in Australia, the ASX 200 ended 0.97% lower to end at 8,013 points. Anyway, for you, and as I have said before, you as an investor, you should not be alarmed by these movements as the share prices go up and down all the time. However, you as an investor should look at companies that have the ability to pay dividends in the current year and increase dividends in the years to come. Okay, let's go into the episode for today. When to sell. Now, when to sell could depend on a number of factors, and which is what we will go through today. Let's look at the first factor. The first factor is that your investment goals have been met. You may have been saving for a particular objective. You wanted to get to a goal of 10% increase on your current portfolio, or a 20% increase, or you wanted to hit a particular number. You wanted to get to a number of 100,000 or 200,000 to your portfolio, which you have achieved. And if you have achieved the goal, you may decide to sell a stock or part of your portfolio. The second factor, which is similar in nature, is profit realization. You had set yourself a goal of a particular profit, the profit has been met, and you have decided to now part ways with the stock and sell the stock. The next parameter, which is what the core objective of this episode is, you may decide to sell if the financial health of the company that you are owning investment in has deteriorated. How do you determine whether the financial health has deteriorated or not? We have a smaller checklist for that. Some of the parameters you could look at is the year-on-year revenue. For you as an investor, have you seen that the year-on-year revenue of the company that you are holding has deteriorated? Another similar factor could be, has the year-on-year profit went down? Um, at the same time, if the revenue has grown, profit has grown, look at the cost. Has the cost profile changed? Has the debt increased? It is possible to artificially increase revenue and profit by increasing cost or taking on more debt. So look at cost as well, the debt profile as well. Look at the financial ratios. In the last two episodes, we have looked at price to earnings ratio, price to sales ratio, price to book ratio, price to cash flow ratio. Look at those ratios and see, is there an indication for the financial health to be deteriorated? Look at the growth strategy. If you have invested in a car manufacturing company, is the does the manufacturer have a strategy to go into hybrid, go into electric cars? If he's still working on the old notion of petrol cars, maybe there is not enough growth strategy to sustain the dividend in the future. Could also be an indication of financial health deteriorating in the coming years, because sales of some of the petrol cars are likely to go down. So these are some of the factors that may indicate that the financial health of a company is deteriorating, and you may consider selling the stock. Going back to our selling checklist again, the next parameters is dividends have been cut. We as a dividend investor are keen on investing in companies that pay dividend in the current year and increase dividends in the subsequent years. If the dividends have been cut and it is not reasonably explained. It may be possible that a company has invested some of the profits into the business, which is an explainable reason. However, if you do not see an explainable reason of that kind, that could be a reason for you to determine that this is the right time to sell the stock. Let us look at it via an example. You would be familiar with one of the largest chip manufacturer in the world, Intel. So Intel, in the year January to December 2023, gave a dividend of 74 cents per share. And in the year January to December 2024, including the dividend that will be announced in October, will be paying out a dividend of 50 cents a share. This dividend cut for the investor, for you, the investor, is not good news. It may impact your cash flow. You may have planned a number of things with this dividend. And if the dividend is cut and it is not explainable, that could be a reason for you to sell a stock. So look at the financial ratio, look at pointers like dividend cuts, which could determine you to sell. Another similar ratio is similar to dividend is payout ratio. From the previous episodes, you would recall that the payout ratio is a ratio of the earnings paid out to you as an investor in form of dividends. And typically, the payout ratio is in the range of 30 to 70%. If you see that the payout ratio is more than 100%, that is a clear sign of investigation, and you should check as to why this is happening. Is it explainable? If not, this could be a reason for you to sell the stock. Let us look at this via an example. You would be familiar with Pfizer. Pfizer is one of the world's largest pharmaceutical companies. You would be surprised that the current payout ratio of Pfizer is an astounding 443%. What this means is that Pfizer has been borrowing money from the market to pay out and sustain its dividend. This is not a good sign. If you are holding Pfizer, it is strongly advisable that you sell it, because in the years to come, you do not know whether Pfizer will be able to sustain its dividend or not. So the last factor in the when to sell checklist is rebalancing your portfolio. Again, um, it is advisable that for you as an investor, there should not be more than 15 to 20 stocks in your portfolio. If you hold more than 20 stocks in your portfolio, it is advised that you bring it to a more manageable number. If you have, let's say, 30 stocks, managing and tracking the the parameters of 30 companies is quite difficult. So bring it in the range of 15 to 20 stocks so that you can analyze the stocks. You can look at it once a year, look for financial parameters, look for dividend yields, look for financial ratios, and see everything is in order, and your dividend for the coming years is assured. However, a higher number of companies means the ability for you to track them might reduce. Another similar uh, advisable is in case of rebalancing of portfolio is the diversification. Many times it has been observed that people focus on one industry. It is not good. You should be distributed. For example, you may be a big fan of technology stocks. However, if all your stocks are in technology, and if technology goes down, your entire portfolio goes down. So diversify yourself in technology, manufacturing, beverages. There are numerous industries, pharmaceuticals, and diversify yourself, your portfolio, 15 to 20 stocks in 4 to 5 industries, energy, utilities. There are many of them to choose for. Choose high dividend yielding stocks using the dividend investing checklist, and invest and balance your portfolio appropriately. Well, that brings us to the end of the episode. So, to all of those watching the episode until now, putting the dividend investing checklist again, I encourage you to use the checklist, assess shares, and most importantly, subscribe to the channel, like the episode, provide comments so that we can provide more insightful videos to you. So, until next time, thanks a lot for watching until the end, and see you soon with another interesting episode of Dividend Investing.